Hello and welcome to Portfolio Matters, weekly markets update, week 213. But before we get into it, Richard will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Due to technical reasons, that was me imitating Richard. So first of all, the news. Well, I'm pleased to report, actually, not too much happened over the last couple of weeks. So, as you're seeing from our cover image, Trump appears to now be threatening Cuba and has paved the way for military action in Cuba by charging the Cuban leader Raul Castro with murder over the downing of two planes in 1996. Now, he did this with Nicolas Maduro in Venezuela. So the criminal charges paved the way for a military intervention to go and kidnap Nicolas Maduro. Are they going to attempt the same in Cuba? He certainly needs something to distract the American public from the failure of the Iran war. Israel has resumed its offensive in Lebanon, which probably isn't going to go down very well in Iran, which considers the Israeli action in Lebanon and the US and Israeli action in Iran to be a single conflict. Trump has repeatedly dangled the promise of a ceasefire agreement in Iran with Iran over the past couple of weeks without actually delivering one. And overnight, Iran and the US have been exchanging attacks. Trump has also, astonishingly, threatened to bomb Oman.
Why has he done that, Keith?
Because basically, Iran has been proposing to manage the Straits
Yeah.
with Oman. And so in this off-the-cuff comment, Trump then said, well, if they do that, we'll bomb Oman if Oman doesn't behave. So, it's difficult to envisage a faster way to reduce American influence in the Gulf. If I was Oman, the first thing I'd do was phone up the Chinese embassy and say, can you sell us some missiles? We can't rely on the Americans.
It's completely bonkers. What does one say? I, I think the oil price is going to go up to at least $150 a barrel over the course of the next couple of months. And even if the war, in inverted commas, is resolved, in inverted commas, tomorrow, the fallout is going to last for many months.
Well, that's what I've been betting on, Richard, and it ain't been working. But more on that, much more on that to come. But thankfully, no political crisis in the UK in the past 2 weeks. We await the Wakerfield by-election.
It's all gone very, very quiet, hasn't it?
It has, marvellous. Um, so you'll all have been aware it's been red hot in the UK. So 35.1 degrees C in Kew Gardens, a new record. It is El Nino this year. Prepare for a hot summer. Now, Kevin Walsh has been appointed as the Fed chairman, and actually, he's been making some quite hawkish comments recently about inflation and the primacy of inflation. So the market is now pricing in some rate hikes. Let's see whether those come to fruition. What's been very odd is since ceasefire negotiations have sort of started, the equity market is totally decoupled from bond yields and crude. So be careful with this chart because crude and the bond yields are inverted. But you can see that as oil prices rose initially, the equity markets fell, and then equity markets have totally ignored oil prices and have just kept on rising. But food prices are rising and they are going to keep on rising over the coming year as the impact of fertilizer shortages slowly works its way through the system. And I thought this was a very interesting chart. So the blue line is EM equities, and the orange line is EM equities if you exclude semiconductor stocks, mainly South Korean and Taiwanese ones. Essentially, if you exclude the semis, then EM is showing clear signs of stress due to the oil shortages impacting their economies. Now, I was listening to a very interesting podcast yesterday talking about the difference between the oil crisis in the early 80s and the oil crisis now. And they're making the point that in the 1980s, the marginal buyer was the US because it ran a big oil shortage. Now, the marginal buyer is EM. And so EM is already showing signs of oil distress, but this has big implications actually for the oil price because if the marginal buyer is EM and obviously is less wealthy and can afford less than the US, then demand destruction is likely to happen sooner in EM countries and the oil price is likely to go less high. Okay, war news. Right, there's loads of it. I'm not going to go through it all. If you're interested, pause, take a look. But what you need to know is the US has repeatedly claimed that it's very close to a deal, that the main points have all been agreed and they just need sign off. And then nothing happens. The main sticking point still appears to be the status of Iran's stockpile of highly enriched uranium. The two sides are deadlocked on what will happen to it. And while that remains true, the straits remain largely closed. Now, Iran is proposing that during the ceasefire, it continues to manage the strait in agreement with Oman. Now, obviously, Trump is unhappy with Oman over this, but it claims it can do this under the UNCLOS, the UN's Convention of the Law of the Sea. Pause, take a look. And and Iran still has huge stockpiles of drones and missiles deep underground. Now, when in the war, the US and Israel bombed the entrances to these, but CNN has been analyzing what's been happening, and Iran's been digging them out and digging them out quite quickly. So this is one of their underground missile bunkers. You'll notice that there are no craters here where so they haven't tried to actually destroy the underground bunker. What they've done is they've bombed the entrances, and Iran's now dug two of them out, and it's busy digging the other two out. So Iran is preparing itself for a restart of the war, frankly. Now, this is oil draws, and inventories are drawing down, and this is Japanese oil inventories. So they are drawing down fast. Now, how low can this go? Another couple of months? And oil prices are absolutely having an effect on discretionary spending in the US and presumably everywhere. But you'll notice that consumer spending has not dipped negative, even though consumers are spending more on gasoline. And that's because they've been drawing down savings. And yeah, this is a good summary of where we are. We're negotiating, making progress. Then Iran will face punishment if no deal. And then we're expecting to hear from Iran. Now it happens. Repeat. So the Institute for the Study of War had a very good assessment of the current status quo and essentially pause and have a read. But the Iranian hardliners are currently opposing any deal that does not give them both control of the states and control of the uranium stockpiles. While that remains true, it is unlikely that there will be a deal. Now, the FT have separately reported that the hardliners are losing influence within the regime. And so really we're waiting for internal regime change in Iran before we can get a deal. So let's have a look at the latest BCA charts on the oil flows, etc., through the Gulf and how the war is affecting the global economy. So, no change to oil flows. Around 9 million barrels remain shut into the Gulf. Tanker flows, despite anything you've heard, remain absolutely minimal. And this is day by day flows through the Strait. I don't think you can say they're improving. There are the odd day where a few vessels get through, but there's no trend there. Tanker hire rates have actually fallen. Now, you can look at that in two ways. Either they're fallen on peace hopes with the oil price, or they're falling because actually there are a lot of vessels with nothing to do. So freight rates have come down naturally due to supply and demand. Supply chain stress continues to rise. The SPR is being drawn down, and notice how it is now at half the level it was before Biden drew down a lot of it during COVID, or after COVID, sorry. And this is US gasoline prices. They have continued to rise despite actually Brent and WTI being down over the past couple of weeks. Diesel prices remain elevated, though they're down from their initial highs. I thought this was really interesting and counterintuitive. So European jet fuel prices are well down from their highs and they're actually falling. So I frankly was expecting jet fuel prices to keep rising, as you can't make much of it out of a barrel and the stocks aren't very high. But this suggests that supply chains are rejigging themselves quite quickly. Note, however, they are still, what's that? Well over 50%, actually probably 80% higher than pre-war levels. So still a real effect from the war, but flight numbers show no impact. They're actually up 4.3% year on year. Urea prices, so fertilizer prices, remain very elevated. They have come back a bit on peace hopes, but still very high, and that is feeding through to higher food prices. But that will impact crop yields with a lag. So expect food prices to keep on rising. And inflation expectations have stopped rising, I think, is all you can say. They've come down a bit. But if this disruption continues, then oil prices will rise and they may soon go back up. So bottom line, the Straits remain under double blockade. Now, last Friday, Donald Trump tweeted that he was calling off the US blockade. Nothing happened. The US is still blockading it. So essentially, this slide is exactly the same as it was 2 weeks ago. We're on unstable stalemate. This can't last. Eventually, oil prices will rise to the point that it forces the world economy into recession. We await the next outbreak of hot war. Richard, your thoughts?
It's not going to be resolved anytime soon, is it, Keith? I think we can be pretty clear on that. And I think that clearly the releases of from reserves are serving to keep the spot price of oil down. At some point, and it depends which commentators you listen to, but at some point over the next 4 to 10 weeks, the release of reserves starts to become highly problematic.
Yeah.
At which point there will be a total shortage, and the only way to rectify that will be demand destruction by price increases. Obviously, what's happening at the moment is that all governments are trying to keep the prices down so that they can pretend that everything's hunky-dory and pretend that there is no inflationary issue. So it's a little bit like holding that proverbial beach ball underwater. At some point, it's going to escape and it's going to go bounding above the surface. Yeah. It's just a question of when. I personally think it it's inevitable that it will do so. I just don't know when it will happen.
Yeah, I'm the same. I think that actually Iran, as we talked about previously, Iran's best strategy is to wait for the oil price to go to the moon, and that puts enormous pressure on Trump to back down. And
Yeah,
essentially, we're waiting for that point.
yeah.
And Trump's approval rating, you're looking at the red line, continues to decline, so he's under pressure.
Ironically, Trump's best strategy, quite possibly, or good strategy, is to wait for Iran to become so unstable that there's regime change. But
Yeah,
those two are sort of mutually incompatible. The best strategy for each of them, for different reasons, is to wait
yeah.
and to continue the conflict at a low level.
Well, the thing is, if I was Trump, I would be seriously considered seeing bombing again because you want to force regime change in Iran by making the moderates think we've got to get rid of the hardliners and come to a deal.
Yeah.
But you also read that the US it will take until 2029 for the US to fully replenish its stocks of munitions. So there is a question of how much bombing the US can actually do.
And also the question is, what does it bomb? I mean, the command structure of Iran appears to be very dispersed.
Mm.
And what do you actually bomb in order to make a difference? You can't bomb cities. Well, you
Yeah.
can obviously, but it probably wouldn't be advisable for him to do that. What is it that you take out? But
Well, I think you take out the hardliners if you can find them.
yeah,
And
that's the issue, isn't it? I don't know
yeah,
where you find. Do they know where they are even?
yeah. Well, Israeli intelligence has been astonishingly good at finding them, but
Mm.
people react to events, and I'm sure the Iranians have now put in, security measures to make their locations much more difficult to find.
Well, I believe they, well, not I know particularly, but I believe they're using couriers as opposed to any sort of form of electronic
Yeah,
communication. And so that's very, very difficult to track, I'm sure. So
yeah.
I mean, ultimately, one of the potential outcomes of this is a permanent stalemate, and simply that oil production, some of it gets pipelined out of the Gulf, some of it gets locked in forever, and the world and the supply chains slowly adapt.
Well, I think it will. I think there will be a peace process at some stage. Both sides need it, but I think it will take how much higher oil prices and time to concentrate mines.
Yeah.
So actually, on Richard's point, when do we expect the tanks to start to run dry and the oil price to go to the moon? So the Brookings Institute had an interesting piece on this. They think that flows through the Straits of Hormuz were around 15 million barrels a day before the start of the war. And then they fell to initially 2.5 million and then 1.5 million after the US joined the blockade. Now, but their point is that is not the impact on the world economy because there was some short term buffers and some permanent buffers. So if you look at this chart, initially, actually, the world didn't really have to adjust very much because you had Russian floating storage, there was sanctions relief, so that came onto the market. There was an SPR release, and then the US allowed Iran to sell its oil. So actually, they're saying in April, the adjustment was smaller than in March. And now in May, we've used up Russian floating storage and also Iranian floating storage. So now we are in June. We've still got the SPR release, but that runs out in July, on the 9th of July, they estimate. And
So,
then you're going to be stuck with 7.1 million barrels a day of adjustment.
so what are these permanent buffers, Keith?
Okay, so the permanent buffers are the offsets. So you've got the pipeline through Fujairah and you've got the pipeline across Saudi Arabia. And both of those, they're rapidly moving to expand. And so the longer this goes on, the more side routes there will be. And I'd say in 5 years' time, you probably expect the Straits of Hormuz to be irrelevant, that everyone will have found a workaround. But
Yeah.
right now, um, you've got offsets of 6.4 million barrels a day. So if you think that there's around 1.5 million barrels a day going through, they estimate plus 6.4, you're talking about 7.9, and then you've got 7.1 of adjustment coming. But the point is that so far you have not had to adjust anywhere near that level. And
Yeah.
June, we've still got the SPR releases. In July, unless there's more SPR releases, then you're going to see a bigger impact.
There's just
And
some, there's
well,
a there's a problem with that chart, Keith. If you just go back, isn't there? Which is that there hasn't been a market adjustment, yeah, as yet. But the implication is that the market has adjusted by up to date by 4 million barrels of oil a day. I don't think it has.
no, I don't think it has either. I mean, there certainly has been some minor adjustment in some emerging markets, Philippines rationing fuels, etc. But I think that is minimal. So I
Right.
was listening to Roy Johnson of Commodity Context yesterday, and he was saying it didn't make sense. He was saying that, the supplies of gasoline, etc., just seemed too high and incompatible with what we know of the fact that Chinese refineries have been cutting back. And
Yeah.
he thinks the only explanation is that China actually has big stocks of refined products
Yeah.
and which they're releasing onto the market. But again, that is finite.
Yeah. So I think if you go back to that chart again, sorry, that we've also got the SPR release, but actually countries around the world are releasing their reserves.
Yes.
So it's not just the SPR. So it's a rather partial sort of US centric view. And as you say, knowing how much reserves China are releasing, we just don't
Yeah.
know. And at what point they will say no more. We need these for times of war and so forth.
Yes. Now, I'm assuming the SPR release is sort of shorthand for releases from strategic stockpiles
Globally.
around the world. Yeah. So the longer this continues, the bigger the adjustment the market will have to make. So at some stage, you run out of buffers, and then the oil price goes to the moon. That remains my opinion. Although, so far, that absolutely hasn't happened. And as we will show you in due course, the oil price is big net down over the past couple of weeks as Trump has successfully once again managed to talk it down.
He's been
Um,
very lucky, hasn't he, actually? Because I don't think anybody realised that there was this much sort of floating, etc., inventory around the world that was available for,
yeah.
for exigencies like this. And I think he's just been extremely lucky that that was the case. I'm sure he didn't appreciate it.
Yeah. So yeah, basically this chart also is unchanged from 2 weeks ago. So we don't think the war end of the war is imminent. Okay, and on to economic news. So data this past couple of weeks, UK retail sales showed that UK consumers are being impacted by political uncertainty and by the war. So retail sales fell 1.3% month on month in April and are now flat year on year. So UK consumers not doing great. The UK services PMI fell sharply in May to 47.9, and that is recession territory. So UK political uncertainty and the war are undermining business confidence, not great. And the April PSBR missed expectations, coming in at a record 24.3 billion for April. And essentially, Rachel Reeves has succeeded in raising tax revenues through all her tax increases, taxing everything that moves in this country. But Labour government have not reined in benefits, so benefits payments, increase in benefit payments more than offset the increase in tax revenues. In the EU, we had the services PMI, which fell again in May to 46.4, composite 47.5. So the PMIs are saying the European economy is not doing well. However, consumer confidence rose unexpectedly in May and inflation expectations fell. So it seems that the European consumers are adjusting themselves to the impact of the war. In the US, we had revised Q1 GDP numbers and they were revised down to 1.6% annualized. Not great. So, US economy, everyone thinks is growing incredibly well, but actually the official numbers are not that strong. I thought this was amazing. Q1 corporate profits were minus 0.4% quarter on quarter annualized. So there's a big difference between corporate profits as calculated for the national accounts and those reported on a GAAP basis, and how much of the corporate profits that were announced by companies was due to revaluing their stakes in Anthropic, etc. PCE inflation was plus 0.4% month on month in April and 3.8% year on year, and rising and going in the wrong direction, well away from the Fed's 2% target, and both core and headline moving up. Manufacturing PMI was incredibly strong at 55.3, but services fell to 50.9. Jobless data was benign. Market news, well, energy commodities were surprisingly weak considering the continuation of the war. Brent was down 16%. UK natural gas was down 9.1%. Hurrah. US natural gas was actually up 9%. Industrial metals generally resumed their bull market. So aluminium was up 2.2%, copper up 4.4%, tin up 4.8%. Iron, though, fell 1.4% and lithium down 4.0%. Precious metals were generally weakly positive. Gold up 0.6%, silver up 2.9%. Rhodium, however, was down 9.7%. And on to equities, Richard.
Thank you, Keith. So generally a reasonably good week period for the equities. So FTSE All World up nearly 4%. The All Share up 1.1%. Stocks Europe up 2.5%. The S&P up 3%. And the Russell 2000 up 6%. And that's up nearly 18% for the year to date. The Nasdaq up 4%, which is 16% year to date. Hang Seng was down, but not much change on the year. Profit was up 2.3%. Bitcoin was down nearly 5% and down 70% year to date. The pound and the euro against the dollar and the dollar index all pretty much unchanged year to date, just bouncing around. And the VIX was down a lot, down 15%, and virtually no change year to date.
Yeah. So one thing, it seems that equity markets are inversely correlated to the oil price. So the oil price in the past couple of weeks down, equity markets up. I mean, the Russell 2000 in particular is behaving as you would expect. So
I'm afraid I'm perpetually cynical, Keith, and I think we've got the fat finger of the Fed, and the plunge protection team is lurking somewhere in all of this data.
Yeah, well, they are buying bonds again and pumping money, liquidity into the system. What's interesting is Bitcoin. Bitcoin has historically been very correlated with software stocks, which have done well over the past couple of weeks.
So
Bitcoin's done badly.
So I read an article. Besant was boasting that the US has basically isolated some Iranian cold wallets.
Oh, right.
So that obviously then that effectively deactivates Iran's cryptocurrency reserves. But what that actually means is that Bitcoin's useless.
Oh, right. Okay.
Now, whether that's behind, I don't know. But if what Besson said is true, Bitcoin is useless because a state actor can isolate your cold wallet. How they did it, I have no idea. But presumably, they do it in such a way that when you plug it back in, it's unusable.
Wow. Oh dear, because Iran was asking people to pay through crypto.
Yeah. So that's interesting, isn't it? But if you've got gold, well, not
Yeah,
the market wanting about gold, you've got it in a vault somewhere, and they've got to invade you to take it. But if you've
yeah,
got Bitcoin and they can isolate your cold wallet, then
yeah.
it's pointless. Oh,
God.
sorry. So this is the FTSE All World Equity Index, looking very healthy.
Yeah, last time we were reporting, we were in this little dip. We thought, oh, has it peaked? No, straight back up.
Yeah, the FTSE All Share.
Yeah, lagging again.
Yes, Stocks Europe, Euro Stock 600, S&P 500, Nasdaq soaring
Amazing,
away,
amazing.
Russell 2000, Hang Seng, topics, Bitcoin, the pound against the dollar, basically just in a range, as is the euro against the dollar, and the dollar index. And all prognostications of the dollar this year plunging off a cliff have proven wrong
Yeah,
so far. There's the VIX, very low.
absolutely amazing, amazing.
So, gosh, the market is up 84% since the launch of ChatGPT.
Yeah, I'm not,
No.
to say the least.
And the S&P 500 is completely oblivious to the war, the potential disruption to the economy,
Yeah,
etc.
yeah.
Which is why I'm suspicious.
Well,
And 4 consecutive highs on negative breadth. Well, there we go. That's another reason I'm suspicious. I am
yeah,
suspicious. Who knows? I've been suspicious before.
yeah. So have I. We've both been dead wrong.
so, new trillion-dollar companies.
Yeah, these are the um memory stocks.
And
Look at that.
semiconductor stocks have gone parabolic. A good buying opportunity, do you think, Keith?
Unbelievable. I mean, on Simon W's, technical
Yeah.
analysis point, I would never have bought them here, you know, but the momentum's behind them. Kaboom.
Yeah.
Incredible.
Micron, Micron technology operating profits, which have grown absolutely massively. Mind you, these are estimates, so time will tell.
Yeah, but also, Richard, I mean, thing is, this is not difficult technology now. It's
Yeah,
just a question of manufacturing capacity. Yeah. And
yeah,
historically, these were the profits, i.e., bugger all, because
yeah,
it's a commodity. Yeah. And so, medium term,
yeah,
they will add capacity, and you're going
yeah,
to be actually worse than this because
yeah.
they're going to add loads of capacity just as
Overcapacity,
demand falls.
precisely. Yeah. So as a bandwagon, you have to jump off very quickly if you're on it.
Yeah. This is Micron's earnings expectations, which are absolutely insane.
Yeah,
As Richard says, can they actually be achieved? Now, separately, all this is being driven by hyperscaler capex, and Moody's has looked at the accounts of the Microsoft, Amazon, Alphabet, Meta, and Oracle, and found they've got 662 billion of off-balance sheet lending, borrowing. So, you can disguise this, but they are clearly investing more than they can support through cash flow. This cannot end. Sorry, this has to end at some point.
wouldn't it be interesting if Meta went bust?
Well, when you talk about their capex investment, you remember they were spending billions and billions on the metaverse. What happened to that?
It was written off. Actually, I don't know if it has been written off, but it's basically worthless.
Yeah,
Yeah, I wouldn't be surprised if one or more of them go bust. So Micron is actually trading at a forward PE ratio below that of the market. But of course, the question is how sustainable are their earnings, and in fact, will they achieve their forward earnings, or is something, as Keith said, going to come and this will hit the buffers, and I don't know. You can't tell when it's going to go tits up, if I'm allowed to use that expression on YouTube.
You certainly are.
But at some point, it is going to go tits up.
Yeah.
You don't want to be in it when it does.
By the way, did you see that Samsung workers have been threatening to strike because they wanted a share of, all this like massive profits?
Yeah,
And so they're going to get $400,000 each.
that's extraordinary, isn't it?
Extraordinary. Absolutely amazing.
So yeah, I mean, it's just it can't end. This whole bubble
Yeah.
cannot end well. Ultimately, there will be
Yeah.
winners and losers, however. So this is just
Yeah.
showing the memory, the prices of memory, and what's happened with the data center capex.
Yeah. Now, I thought this was an interesting chart. So the line is the unit price, yeah, and the grey bars are export value, and they are perfectly correlated. So that implies the volumes are unchanged, and this is the issue. They're just
Yes,
bidding up for
yeah,
the same things, and so it's essentially a race to add new capacity.
yes. But also, looking back on it in a few years' time, these data centers will have been built with wildly expensive kit,
Exactly.
and which will have to be amortized,
Yeah.
and it'll have to be, and they'll be competing against whatever they may be competing against, which were built with much cheaper kit.
Yeah.
So the cost of an AI semiconductor rack is 26% memory, from 9% in the last generation.
Yeah. So they're just bidding up. They just,
But the other thing, Keith, is I don't know. I've got AI later, but the other thing is, the more you, I mean, I've been skeptical about it, to be honest, and I am quite a skeptical person, I know. But I've been skeptical of all the benefits of AI for a long time. Now, it is good in some respects, but gradually eking out is more and more sort of information that says actually AI is good for some things, but it's not good for what it's being touted as being good for, which is replacing human workers.
mm,
And um, I,
yeah, we have something on that later.
yeah. So it's not just that there's probably going to be there's this huge amount of capital spending, which just doesn't really make a huge amount of sense. But actually, that they're spending money on something that doesn't do what
Mm,
they think it does. It's a bit
yeah.
like building a railway, but rather than building it to a city across the continent, they're building it to the middle of a desert. To use an analogy with the railways.
Well, also, as everyone gets used to AI, a lot of the things people use AI, well, things we have to do in life, we're in competition with other people. And so, you know, once everyone gets up to speed with AI, your relative advantage versus other people just disappears. So I had
Yeah,
an interesting experience yesterday, and that my goddaughter was asking me to help her with a an application, and so it was, please answer this in 500 words, and then please explain how you would have asked AI to answer that question.
AI prompt.
What input would you have done,
Yeah,
put in to get AI to answer it? And so, employers are expecting everyone to now use AI.
yeah,
And, you know, but again, it's like they're only going to hire like 5 people for this internship. So it's a question of, you versus other people, not, any absolute increase in the people's ability.
yeah. And it's also as businesses start to use AI for things it can be productively used for. As you get adoption across the board, competition keeps the margins what the margins were before. There is, you may get a temporary benefit, but you don't get a super margin out of it ultimately.
Yeah.
So it's a little bit like just because you've adopted the internet and you've got a website, you don't suddenly make double your profit margin. No.
Yeah.
If you didn't do it, you would go bust. But by doing it, you maintain industry normal profit margins. So there's a sort of there's an economic fallacy going on in people's heads that the companies that adopt this are going to be fabulously profitable. Well, they're not. They're just going to have to do
I,
it to keep up with everybody else.
I totally agree. Yeah.
So excluding AI stocks, the S&P would be up 3.5% year to date, which actually isn't a bad return.
Mm.
Annualized 8%.
Yeah, that's true.
And chips are heading to be the S&P 500's largest industry group for the time being.
Yeah, well, when you look at .com, further to go,
Yeah,
possibly. Question mark.
yeah, that's very true, Keith. Actually, yeah.
Yeah.
So maybe it is a good point to invest.
Hmm.
You heard
That's
it
not
here
investment
first.
advice.
um, and analysts seem to believe that all AI expenditure will lead to permanently, which is a comment we were just making. Of course, it won't. It'll lead
Yeah.
to permanently normalized earnings growth as everybody adopts the same stuff.
Yeah, exactly.
Self-evidently.
Yeah. So, I mean, this is why we think this market is overvalued in one chart, basically. I just don't see how you can have permanently higher earnings growth without permanently higher GDP growth. And
Yeah, exactly.
GDP growth is not accelerating.
Which means that the premium that companies are able to pay for AI also drops.
Mm.
In fact, they're not paying a premium at the moment. They're getting it pretty much for free, courtesy of the VCs, but that's going to change.
Yeah.
And then there's going to be a nasty surprise. So I read somewhere just the other day that someone did a proper calculation of what it would cost to do a piece of programming, I think, using AI. And if you use AI and cost it properly, it's more expensive than getting a human programmer to do it.
Really? Mm.
Yeah. Now
Well,
AI is useful for programming, but there's going to be there's going to be a happy medium where you use AI to get rid of the sort of grunt work and then the human program, but it's not a panacea. This is US household equity holdings.
yeah.
4 trillion gain in household equity wealth year to date. That's why one of the reasons the economy is doing so well.
Yeah, absolutely.
And this is the .com Keith's point from a few minutes ago. This is the .com bubble. Netscape,
Yeah.
147% gain in 866 days in Chat GPT.
Yeah. And once again, Richard, I've totally failed to take advantage of a huge bubble. There you go. Just like next
That's
time,
because
next 20 years' time, I'll try and get in.
that's because we're too logical, Keith, because I also
Yeah.
failed to take advantage of this.
And let's talk about Nvidia results, which were out the past couple of weeks. So they reported an astonishing 82 billion in Q1 revenue. And look at that chart, just go rising. Actually, you'd say it's accelerating, up 85% year on year. Q2 guidance of 91 billion, both ahead of consensus. And look at the earnings. Wow. Earnings up 214% year on year. And I think a year ago we thought this was unsustainable. Well, we were dead wrong.
Yeah, so if we just come back to that point that Nvidia is recognizing the sale in its earnings, and the companies buying them are not recognizing the cost in their P&L or their balance sheet.
Yeah. But also this includes, revaluing their equity stakes in X, Y, and Z. It's carrying an awful lot of inventory. Look at that. 25 billion of inventory. But, their sales are increasing so much, inventory to sales are stable. And it's launched a new Vera Rubin AI platform, which will succeed Blackwell. And the point is that the new CPU has been designed by ARM, who specialize in, low energy consumption chips. So these should be more efficient. So, data centers will be forced to upgrade once again. And actually, this morning, I haven't had a chance to put this in, but they've announced that they're developing an AI chip for PCs to allow people to run AI models on their home computer.
What will that
And,
do to data centers then?
well, yes, that's a very good point, actually. So, and this is OpenAI's CapEx just increasing exponentially. And, all that money just flows into Nvidia. But this is totally unsustainable. This is fueled by investors and
Yeah.
hope. Meanwhile, China is not going to be a source of demand for Nvidia chips because they are becoming increasingly self-sufficient. The US puts sanctions on China and stops chip exports, so they
They make
build
their
their
own.
own. Yeah,
What a
absolutely.
surprise.
And
A bit like the analogy, sorry, is just to go back to the Straits of Hormuz. Iran closes the Straits of Hormuz. Gradually, the world adjusts and doesn't need Iranian oil anymore.
yeah,
Ultimately, that's the end game, isn't it?
yeah, absolutely. And after beating massively, well, actually, after beating, the market was unimpressed. Shares down. So, how much is already in the price? Question mark. And continuing on the AI boom, and Richard, just come in when you feel like it.
Mm.
Um, the FT had a piece on how the economics of this just does not work add up. So US investment in information technology is now massively higher than .com, and Panmure Liberum calculate that 93% of US GDP growth over the past 4 quarters was due to tech investment. So it's massively propping up the economy. And I mean, look at this. You know, capital expenditure as a percentage of GDP. Astonishing.
Mm.
And their point is that this just can't work out. The maths are terrible. So if they assume that in the next 5 years, hyperscalers um, capex is forecast to grow by 20% per annum, while revenues grow at 15% per annum. Okay. Now let's assume that there are no costs. So this is quite a big assumption. No costs, all revenues are profits. Even under that assumption, only Amazon has a positive return on investment. So,
So Amazon set a target for their staff to use AI, and they linked it to some sort of bonus or performance review. So everybody was using AI all the time because their target was to use AI as much as possible, but not necessarily productively. And Amazon got this enormous token bill,
yeah,
and so then they told the staff to stop using AI.
yeah,
I mean, it's a complete nonsense, isn't it? I mean, the whole thing is just it's completely irrational.
yeah, I think it's irrational. It's just way, you know, it's everything is being led by this enormous investment boom, which is just built on hope. Um, So the market is rewarding the recipients of AI capex largesse. So, Nvidia and all the hardware stocks. But, the share prices of those spending the money ain't doing so well. So is the market already getting a bit skeptical? And meanwhile, DeepSeek has launched version 4, which is 50 times cheaper than OpenAI and Anthropic. Now, I'm sure all of you have been hearing from friends who use AI and talking about how the latest models are much more expensive, and companies have actually been cutting back or telling their workers to reduce their usage. And the fundamental problem is that the new models, they're marginally better, but they're much more expensive. So if you look at the bottom chart, that is a log scale, whereas the y-axis is a linear scale of how good the models are. So you get a linear increase in performance and an exponential increase in price. And that can't carry on because people will just choose to use the old model, which presumably you're giving away free, or they'll choose to use DeepSeek, which is 50 times cheaper. So I don't think that these AI companies have any pricing power, full stop. They're in a constant race to improve their models, but they're becoming increasingly expensive and therefore uneconomic. And Richard's point about how good AI is. So business surveys have looked at how effective $1 spent on AI is. And the reality is, $1 spent on AI is reported to result in less than 20 cents worth of economically useful output.
That doesn't make sense then. That means that you'd be better off not using it.
Well, depends how much, if that means it makes a big difference, it can still be effective. And if you're replacing an expensive employee, you know,
Yeah, but if you spend $1 of an input and you get 18 cents worth of output, you go bust in short order.
well, not if it's more than, 5 times efficient to use it. If you were placing, a Charlie in the
Well, yeah,
compliance,
but then okay. I mean,
so
I think the point here is that it's not all it's cracked up to be by any
yeah,
means, is it? There's an awful lot of human intervention that has to be made in order to get the AI to be useful.
yes, precise. Well, this is because most of it's spent, a lot of the money is lost in bug fixing, essentially. So, and also, all these forecasts are predicated on, adoption going through the moon and increasing exponentially, but it appears to have stalled.
Hmm.
That's interesting. How does the profitability conundrum get fixed? Well, they were suggesting two ways. Either revenues are being underestimated. So the you do have positive return on investment because actually you make much more money than anyone is currently assuming. And given the revenue assumptions seem very optimistic at the moment, I somehow doubt that. Um, and also the AI investments of such size that you'd have to underestimate future revenues by literally trillions of dollars. Where's that going to come from? The alternative is that most of that AI investment never materializes because the market at some stage says, stop, you're not making it, going to make any money out of it. And when the investment slows or stops, then, GDP stops, growth slows, and the market takes a bath as the market is currently discounting continued growth, well, this capex to continue for a long time. So the author thinks the market will survive 2026, but then kaboom. So bottom line is, as we've been saying for a while, you need to be nimble. And more on that in a bit. And meanwhile, and again, talking about this earlier, the AI is producing a world of slop. I mean, look at the number of scientific papers that have been produced since the advent of AI. Just huge increase in like music, lawsuits, ebooks generated by AI.
One of the problems with all of this is that AI uses its self-generated AI slop to train itself. So ultimately, the
Yes.
whole thing degrades into a mess of ignorance.
Yeah, great.
Definitely. So, having a look at SpaceX, fantastic photograph there.
Do you want to read this out? This guy.
Quite long. Okay, from the SpaceX IPO prospectus. We believe that our current space efforts will catalyze transformative breakthroughs that could reshape terrestrial industries and lead to the emergence of new trillion-dollar markets on the moon, Mars, and beyond. In particular, we believe our goal of establishing a lunar presence will enable terawatt-scale annual AI compute growth, support deeper space exploration and industrialization, and serve as a stepping stone to establishing a civilization on Mars. We believe the next paradigm shift for humanity is the creation of a resilient, perpetually expanding, spacefaring civilization that drives continuous innovation across new frontiers, ultimately propelling us to Kardashev Type 2 status. We believe we are capable of unlocking an era of unprecedented economic expansion while also contributing to the safeguards of humanity's future against existential risk, written by your friendly local AI bot.
Isn't that amazing? It's like SpaceX is essentially a science fiction novel.
Yeah, I mean, I was watching a very interesting video the other week about the impossibility actually of getting to Mars, never mind getting back from it. with current rocket technology, and it is
Ah,
impossible.
yeah, you're too much of a cynic, Richard. He's gonna
It's not
invent.
possible, Keith. It's
Yeah,
not possible. You can get them, you can get people there, but they can never get back. And not only can they never get back, you can't get them there with sufficient life support to make life sustainable.
can we send Elon Musk there just to try it out? He seems convinced.
But if you get nuclear rocket propulsion, then that changes,
Oh, really?
and
Okay.
the equations start to work because the weight of the fuel versus the
Mm,
specific impulse you get.
great.
But of course, I mean that's a big if, isn't it? And it's also it's quite probable that we will ultimately develop nuclear propulsion, but it will take a long time to work. To get
Yeah. Given the what happened to the Blue Origin rocket this week, the idea of sending up a nuclear reactor to space does not fill one with joy, really.
I just you're just you're being too sensitive to environmental issues, Keith.
Mm.
Okay, mentions of words, phrases in SpaceX. Age of abundance, human augmentation, and civilization. 24 times. So anyway, first person, light of consciousness, 10 times.
Yeah,
Wow.
absolutely. But it's
Multiple,
AI,
multiple times.
1,251 times. So essentially,
Oh, yes.
he's making a pitch for SpaceX being an AI company above everything else.
Yeah. So I personally am not going to be investing in SpaceX IPO.
What? I'm shocked, Richard.
Um, I just um, I just feel it's a bit too stretched for my liking. So
Yeah, you
uh,
don't want to participate in the future of humanity.
yeah,
I'm
I know.
shocked.
I'm going to be digging a bunker instead. So Elon. So basically, it's a very much loss-making business, and it needs money to finance those losses. And it's
Yeah,
called, these guys. Elon Musk is very, very clever, but he has his detractors, and I don't know what he's like as a person. He's a very, very clever, capable man. Clearly, look at the track record, but he has to talk this up because he needs to raise money, and that's what he's
yeah.
doing.
So, and the thing is loss making. It's increasingly loss making, and they want to IPO it at 107 times sales, a valuation of 1.75 trillion. Right. So the average S&P company trades at 3 times sales, and he wants 107.
Yeah, so it's got to grow 300 times basically in earnings in order to in sales in order to
Yeah.
assuming it has a average profitability. Starlink, which is a little satellite business as opposed to small business on satellites,
Mm.
um, makes most of its money from Starlink. Is losing it. I mean, it's got sucked into this AI race, isn't it? But I actually thought that Musk's AI gambit was Grok.
Yes. And apparently Grok is losing engineers
Right.
to its rivals because the engineers don't think it is at the cutting edge.
Okay.
But notice how margins in space have been falling. Actually, it makes all
uh,
Starlink.
SpaceX's merger with Grok
Mm.
brought the aerospace company into a loss-making position.
Mm.
Mm.
Insane.
Yes, yeah, isn't it? What can you say? It just makes no sense.
Yeah.
Total
I,
addressable market. Actually, a total addressable market is the GDP of the US.
yeah. So what? They're all just going to spend all their money on SpaceX. They're not going to eat or anything else.
Well, it's the total. I mean, what's the global GDP is roughly 80 trillion, I think, isn't it? So
Yeah.
let's just be generous and say the total addressable market is one third of global GDP.
Yeah. Great.
And it's an enormous, historically, absolutely enormous IPO.
Yeah. Although that's the total value of the company. Obviously, he's only spending, sorry, only listing between 4 and 5%.
Yeah. So launch costs have, however, dropped really dramatically, haven't they? Not fallen 95% since
Yeah.
2008.
Exactly. But then he's saying that, it's going to be super profitable. It would seem to me, this says that he doesn't have pricing power.
Yeah. So So NASDAQ 100 has bent the rules so that SpaceX will be included in the index 15 days after the IPO, the usual 30. Okay, we'll do that because there's lots of cash in it for them. SpaceX will be included at 3 times its available float as a result of a new rule specifically designed for mega cap IPOs with low float. And index funds own 20 to 30% of the NASDAQ left, although they need to buy 60 to 90% of the outstanding shares in order to track the index. Someone's thought this through very carefully, haven't they?
Shocking. Absolutely shocking.
Yeah, financial engineering and market manipulation.
Yeah.
It will go wrong. I mean, it's just.
Okay, so early on in my career, I used to work for an index fund actually, and during .com, we had similar issues in this, where you would have these little shitty .com businesses IPOing, going into the all share, and the index fund would then have to try and buy them. And we had a disastrous experience where we actually attempted to buy the company at market weight on the date of the IPO and sent the shares, up 30%, only for them to collapse the next day. And so after that, we didn't do it. Basically, we would accept that we would have some tracking error for a period, and then we would slowly buy in over the period. And also, I would say that this attempted manipulation, will it work? Because you can create the synthetic. You've got 95% of shares are not available, but there. And so you can just, create more synthetic shares on the basis of market prices. But I think it's absolutely disgraceful financial engineering and market manipulation on the part of the Nasdaq, frankly. And the S&P are not much better. They're going to drop their profitability requirement, apparently.
To be blunt, it's a train wreck. Unserious, empty, hallucinatory, and borderline dishonest is the view of Ed Adelson.
Yeah.
The whole IPO prospectus.
I think this is just an amazing symptom of the bull market. Really astonishing. There's paying 1.75 trillion for a loss-making company. Really.
Yeah. However, the speculative frenzy of funds have taken stakes in SpaceX, that have stakes in SpaceX, have seen huge inflows before the IPO. I mean, as Keith says, this is all part of the speculative frenzy. At some point, it's going to return to Earth, to employ a space analogy.
Yeah.
Yeah, so the apotheosis of the Ponzi scheme. It's a nice word, that, isn't it?
Yeah.
A fantasy valuation enabled by the investment banks, supported by the major indices and supported by the regulators.
Yeah.
It may be supported by the valuation, may be supported by forced buying by index funds.
Yeah.
There's nothing to suggest that the valuation is remotely justifiable. Our advice is don't entertain these things, really, but you might make a bit of money if you do so. Who knows?
Yeah, well, you can, you might make a bit of money. What's it called? Stagging it, where you buy the IPO and sell it quite quickly. But medium term, that's valuation is going to come down a long way.
So investors, they want to buy SpaceX, they'll have to sell something else, and typically major IPOs are often followed by underperformance in the S&P because of those sales.
Yeah.
But not this time, Keith. This time.
Well, that could well be true. Nothing stops this market, but also we've got Anthropic and OpenAI coming up.
Yes.
I actually am getting really worried now that I think this really feels like 1929 to me, where, new technology, and we're in an earnings bubble driven by this massive capex, and the market seems to be anticipating these earnings carrying on forever. I mean, the memory stocks going through the moon is the latest symptom of this, because that, historically, memory companies have had very low profit margins because there's no moat. Anyone, well, any of these companies can produce the technology. It's just a question of their capacity. And for a brief period, demand is massively exceeding capacity, but you'd expect them to be adding capacity as fast as possible, at which point margins return to where they were. Whereas the stock market valuations are assuming that they'll last forever.
Yeah.
So I just think what happened in 1929 was, when the stock market crashed, it took the economy and everything with it. Now, I'm frankly very worried that when this market crashes, and in my books, it absolutely will, that you need to get out. And so, my well, not advice, but my personal opinion is, yeah, enjoy it while it lasts, but be nimble and be prepared to, sell everything. If it's down 30%, just get out. And when it crashes, and accept that you've still made a huge amount of money, and don't hang on for the, return to the highs, because return to the highs won't happen. But not investment advice, but
Just your
your,
view.
yeah, your thought, Richard.
Yeah, no, I agree, Keith. It is completely unsustainable. My problem actually, I was listening to an interview. I don't know if you've come across a lady called Stephanie Pomboy. She's quite
Oh
interesting.
yeah,
She's being
yeah.
interviewed on a YouTube video. I was listening to it yesterday. Basically, she espoused the view that held for years in terms of what the end point is for the debt laden debt laden governments, debt laden economies. And she laid it out completely perfectly. And I thought, yeah, this has been my position for the last 8 years. And it's only in the last couple of years that my view has started to come into focus for other people. Now, it's still my view, and I'm not saying I'm right, but it's a little bit like, for me, it's a bit like, I just can't quite understand how it's gone on for so long.
So hang on, what was she saying?
So the debt burden is unsustainable, that governments will have to increase interest rates, that the increase in interest and the interest rates will have to increase substantially above where they are now, that the price of hard assets will continue to rise with
Mhm.
the increase in interest rates, not full. That people have no idea what's going to happen to them when interest rates go up to 10, 12, 15%. That governments that there's going to have to be either a default or severe inflation, that basically they're in that trap that you have right in the middle of that slide, Keith.
Yeah. So I take your view, Richard, but I would make a counterpoint
Mhm.
that medium term, that could well be true. But if there is a 1929 style crash, then I don't think that happens at all short term, like in period of the depression or the recession,
Yeah.
because then you'll have deflation, you'll have a massive demand shock, and central banks will try and cut interest rates to zero as essentially inflation totally collapses and you have, unemployment, but basically total lack of demand. And frankly, bonds could have an enormous rally. And we just have to see what happens.
So effectively, what you're saying, Keith, is there are sort of two. Ultimately, you get to the same point, don't you? You actually get to a reset.
Yeah,
But there are two. What you're saying is there are actually two paths, and the other path is a 1929 style crash,
yeah.
as
And
opposed to a gradual descent.
well, medium term, Richard, I'm totally with you that fiscal is unsustainable and something's going to happen. So, but if we had a recession, a deep recession or depression, then I don't think anyone cares. I think basically the system has to carry on. Interest rates get cut to zero. Inflation is no longer a problem. And therefore, bonds look very good. And I think everyone holds their nose and buys them for a period. But medium term, when the economies recover, then that's when you get, debt sustainability problems. And, I'm not going to be betting on this. I'm going to be waiting to see what happens. Learn lesson.
Yeah. Interesting.
Okay, and on to commodities. And first of all, energy commodities. So the markets have been Trump whispered. He continues to, well, they fell whenever he said that there was close to a ceasefire, and frankly, they haven't risen again, despite the fact that no ceasefire has been forthcoming. And yeah, absolutely, I've been surprised by how resilient oil prices have been to the disruption, i.e., they haven't gone to the moon yet. But the longer this continues,
Yeah.
the greater the risk they will do, and I still remain very long oil. Now, good news is that natural gas prices in Europe and the UK have come down, but you'll have seen that the off-gen price cap is going to go up 13% in July. Now, US natural gas prices rose 9% over the past couple of weeks, which is good news, but it's still down 8.4% on the year. Coal rose 3.2%, up 27% on the year. Uranium, flattish, up 4.7% on the year. So this is Brent, down well from its highs at the bottom end of its range, despite this war going on much longer than the 3 weeks initially promised. And the authorities around the world have succeeded in suppressing it. Essentially, the market seems to believe that this will be over soon and prices won't spike. WTI, the same. Numbers specific to the oil market, well, you are seeing big drawdowns in the US. These numbers are 2 weekly changes, but that's a lot. And, it's been half of the drawdown has been provided by the SPR. But again, you can't keep on doing that forever. You are seeing a little bit of response in the rig count. So up 14 over the past 2 weeks and up 17 year to date. So Robin Brooks has been saying that the oil price shows that markets have actually coped well with the closure of the Straits of Hormuz, and that really only commodity bulls expect oil prices to spike from here. And he uses, to justify his opinion, this chart which shows how Korea has adapted to disruptions from the Straits of Hormuz. And basically, although their imports from Saudi and the UAE have fallen, they have compensated for that by increasing imports from Canada, Malaysia, and Russia. But
The question,
God,
question there, Keith, is what's the effect on the total global supply? Are they
precisely,
has Canada produced more, or is it just
yeah,
changing where it's shipping it to because it gets a higher price?
yeah, it's changing where it's shipping it to. So,
So it's drivel. Excuse me.
yeah, well,
is it drivel?
yeah, I agree. It is. I agree. But but at the same time, Richard, how do you explain jet fuel prices coming down? You know, everyone was saying, I'm sure you've been saying that, so I'm sure you've been reading the same people who are saying that, start of June, you're going to see real spikes in jet fuel prices everywhere. Actually, they're heading in the other direction.
But if you go back to first principles, you can't. We have got a roughly 7 million barrels of oil per day deficit.
Yeah.
And that will work its way through all of the inventories wherever they are.
Mm.
And this is just mathematics. So then once the inventories are used up, we're still 7 million barrels a day short. And this sort of fiction that is being created, is it being created? It's very much in the interests of administration, government administration,
Mm,
to manage these markets and to release fuel. And if you look at, because to not do so results in immediate as opposed to deferred
mm.
economic damage. I just think that these are all of our reserves being released.
That could well be true. And, presumably Europe. So presumably Europe is getting a lot of jet fuel from the US. And that's why you're seeing inventory drawdowns in the US.
And the
How long is
US is
this?
supplying
Oh,
Australia. So I was going to say the US is supplying Australia with diesel.
yeah. So, but again, the inventory drawdowns in the US are not sustainable long term.
Yeah.
So let's see how long this lasts. Um, this is the US Big Four storage, you know, dropping. And now this is interesting. So this is distillates in the US now, and HFI Research think that you're going to approach the operational minimum quite soon. Okay, so next 4 weeks. At that point, you can't be exporting them anymore. And this is gasoline. So the last word is distillate. This is gasoline. Same story. So we're going to find out about whether all the commodity bulls are right in their diagnosis that the oil price will have to go through the moon. Actually, gasoline prices will go through the moon within the next month, I would say. And when we look at break evens in the Permian, which is where the marginal producer is, well, they've risen a lot actually over the last few years. And so you're not going to see oil prices going back to $60 at the end of this. December Brent futures remain at 85, down from their highs, but still saying that by the end of the year, oil prices will be very high. And good news for oil bulls like me is the capex cycle really hasn't started yet and shows no sign of starting. So oil companies are not announcing big increases in their capex budgets. So we won't see a big supply response. Everyone's saying that, at the end, whenever you've had a big price spike, you're generally followed by a big price collapse because there's a supply response. Well, you ain't going to see a supply response if nobody's investing. And this is a really good, interesting chart of long-term oil prices. And you can see that actually you can see that currently oil prices are actually not that elevated. So hence they're not having much of an effect on the world economy. During the whole period from like 2009 to 2014, they were much higher than they were now. That was before the shale revolution really got going and has suppressed oil prices ever since. Now we believe that the boom from US shale is coming to an end, and within the next few years, US shale production will actually start to fall, at which point things get interesting. So this is EU natural gas prices up from the down over the past couple of weeks, and EU storage is well below historic norms. They have got to refill the tanks a lot by November. Otherwise, prices are going to go through the moon next winter.
Or
So
does it go through the moon because they've got to refill?
that's true. Well, prices are elevated,
Yeah.
but that's where we are now, you know.
Mm.
So we've got to buy a lot of LNG from a market where Qatar is offline. But we've shown you previous charts showing there has been big growths in LNG, the LNG market, despite Qatar being offline. So perhaps they will easily manage to do this from elsewhere, from the US in particular. This is UK natural gas futures, same pattern, not rising steadily, which is a good thing. The US which are still low, frankly. This is coal. So some switching into coal. Coal has joined in the energy mix, and uranium. Richard, industrial metals.
In case. Okay, so aluminium up sharp 22% year to date. There is an aluminium supply problem now because a lot of it comes out of the Strait of Hormuz where it's been smelted in plants. Cobalt unchanged, copper up 4%, so copper's up 14% year to date. It's a significant increase. Iron ore pretty much unchanged. Lithium carbonate up 51% year to date. Interesting, isn't it, that electric vehicles are now, was it 40%? In the UK, the sale of electric vehicles has risen very dramatically recently.
Yeah.
Which is going to put pressure on lithium supplies, presumably, if it's replicated around the world and in an overall sense. Neodymium down 3% for the week, 24% up for the year. Nickel up 14% for the year, up 1.4 for the week. Tin 35% for the year, 5% for the week, I think. 1.2 for the week, and 14% for the year. So basically, the story is all of the commodities, with the exception actually of iron ore, are up fairly significantly for the year to date.
Yeah, absolutely.
Higher than more than the Nasdaq in the main.
That's true. That is very true.
So there's aluminium.
But again, a lot of the in the case of aluminium, this is due to disruption from the supplies from the Gulf. But in the case of, let's say, copper, you're getting sulfuric acid disruption. So, as we've talked about before, some producers will not be able to produce and will not be taking advantage of these higher prices.
So my question now is, to what extent has production been curtailed because of the sulfuric acid shortage as of now?
Yeah.
Or has it not really impacted?
Yeah. That's a very good question. We'll just have to wait for quarterly results to find out.
Yeah. Says cobalt. Copper.
Yeah. Just grinding higher.
Yeah. Iron ore. Lithium. Neodymium.
Actually, while we talk about copper, the Grasberg's still not back online.
Is it not?
It's due to be back online in Q2. Well, I haven't heard anything.
Which means there's not much left for Q2, is there?
Yeah.
Nickel.
Now, nickel is investment banks are saying nickel will be most affected by the lack of sulfuric acid. So, yeah.
Tin. Zinc. Precious metals. So it's fairly sort of miserable year to date, actually, for the precious metals. So just looking down that, gold's up 4% year to date, silver 6%. Platinum down 5%, rhodium down 4%, and palladium down 15%. So a quiet year so far for those.
Yeah, everyone's switching out. Basically, stock market doing so well, Yeah.
So there's gold. Silver.
Yeah, interestingly, silver seems more stable than gold does.
Yeah, and they're both consolidating, aren't they? In my view, prior to moving up again. Time will tell. So silver down for third month in a row. Platinum. Rhodium. Palladium.
Yeah. PGM's not great.
No.
Thank you, Richard. On to rates. Well, I'm very pleased to report that the UK yield curve shifted down over the past couple of weeks as a pause in the UK political crisis has allowed markets to recover a bit. And also bonds seem very correlated with oil prices, which are down over the past couple of weeks, but still massively up over the past couple of years. Not good. And in contrast, US bond yields did not fall as much over the past couple of weeks. In fact, they're still up over last month. Now, the FT had an interesting piece on the gilt market and showing how massively gilt issuance has increased over the course of the past 20 years. Really massive increases, particularly during both the GFC and COVID. And between the two of them, they have destroyed UK finances because benefits massively shot up during COVID and not come down. And sadly for the UK, a lot of that issuance used to be bought by UK pension funds to hedge their liabilities, but defined benefit funds are now in drawdown and no longer buying. Instead, they're going to be selling. So that removes a natural buyer of long-dated gilts. So long-dated gilts will tend to be have a higher yield from henceforth. Or the DMO just needs to stop selling them, essentially. And so who's replacing UK pension funds as the buyer of gilts? Pause, take a look. Non-residents, foreigners. So Andy Burnham, when he talks about how markets should not be setting UK bond yields, well, the market is setting them. If he attempts to manipulate the market, you remove a massive natural buyer. Well, the marginal buyer, i.e., overseas investors in UK debt. We need them. But when you look at the fundamentals of the gilt market compared to everywhere else, basically everywhere is awful and we don't look too bad. So as long as the Labour government sticks to its fiscal rules, the gilt market should be recover, question mark. The big point of this FT article was that the UK does not issue enough short-term debt like T-bills, and if it issued more T-bills, which have got the lowest interest rate, it could actually buy back longer-term debt and cut both our interest bill and our indebtedness. Will they do it? I think we know the answer. And rising bond yields everywhere have been driven by rising inflation expectations. So no big sell-off on expectation of sovereign default, but rising as the war and oil prices increase inflation expectations. Reminder, inflation is absolutely catastrophic for your saving, particularly if Wes Streeting comes in and raises capital gains tax to equal income tax, which would be 45% from the marginal buyer. At 3%, you would basically be losing 1.5% per annum of your savings in tax. This is the Turkish lira versus the dollar, and shows it's collapsed by 99% over 15 years due to high Turkish inflation. So this UK 2-year down actually a lot, actually 25 basis points or so over the past couple of weeks. There's the UK 10-year, the same 30-year, hurrah, down from its amazing highs. US, similar. Germany down. France, not down. Italy, doing okay. Greece and Japan, even Japan's down. And on to current investment themes. We've gone through this all before, but outlook for equities, well, very strong US earnings and the world economy remains resilient. But if oil prices spike due to the Iran war, then all bets are off. And at some stage, this unsustainable surge in AI investment is going to end. And then I think there's a massive reappraisal. The big themes at the moment, frankly, is AI. And memory chips are the latest semis to go through the moon. So as long as this concentration on AI continues, and essentially it's hope. Hope is driving the markets. Hope that AI will can transform the world and lead to higher corporate margins in future. Richard and I are skeptical, and we've been skeptical for a very long time now, and AI stocks have continued to go to the moon. Okay, and on to this week's economic data. So, quick summary, UK stagflation, but service PMIs fell sharply in May. Is the UK economy starting to run out of luck? EU stagflation as well. EU economy not doing so great. US economy continues to tick along. So reminder, stagflation is good for nobody, but it's best for commodities and worse for bonds. Richard, the UK.
Thank you, Keith. So UK retail sales down 1.3% in April and unchanged year on year. Manufacturing PMI 53.7, so basically unchanged.
Yeah. UK manufacturing doing all right, actually.
Yeah. Services PMI substantially down at 48.
Yeah. Pause, have a read. But basically, UK political crisis plus the war in the Middle East undermining business confidence and job shedding in accelerated. Not good.
So there's the composite, which came in at 48.5. And UK businesses are reporting a surge in cost pressures, the biggest actually being in manufacturing PMI input prices.
Yeah.
It's not good news. CBI industrial trends on new orders of 48.5, so worse than expected and down on the previous month.
Yeah, but there's contradiction here between this and the manufacturing PMI, which is doing just fine.
Yeah. And CBI distributed trades only minus 46 in May, as opposed to minus 68 in April.
Yeah, still awful.
Yeah. The consumer confidence index minus 23 in May. So
Yeah, I think the fact that oil prices haven't gone through the moon and that had so gasoline prices at the pump are not too bad has been good for consumer confidence.
PSBR, as Keith referred to earlier, is dreadful. And indeed, weekly jobs postings sort of leveled off over the last few weeks.
Yeah, but no improvement.
No. UK wage growth 4%.
Yeah, still too high.
Yeah. And the NEETs, not in education, employment, or training, has increased to, was it 13% or so? But it's actually 1.2 million people between the ages of 18 and 24, which is a complete, 16 and 24, which is a complete disaster economically and societally.
Yeah, and so Labour's planning to fix this through more state intervention, essentially, paid apprenticeships. All you'd need to do is just remove the minimum wage for young people, and these jobs would miraculously appear. Every pub would hire a new person, etc., etc.
Yeah. Yeah, or you can do it, and you can mess around with national employment insurance, can you? You could say if you hire someone who's less than the age of 24, that there's no employer's national insurance.
Yeah,
there's loads of stuff that you could do, and I wouldn't be averse to that sort of subsidy to get these people into work, and off whatever benefits they're on, and also out of a what must be a soul destroying sort of life.
Well, exactly.
A lot of these people have got university degrees and student debt, because they were conned into taking that out by very successive governments. And then Rachel Reeves goes and arbitrarily increases the interest rate on student debt because it's a good way of government making a bit more money. I mean, the whole thing is so immoral and unjoined up. It's just extraordinary.
Yeah, I totally agree. Now, this is a really interesting chart from Magnets, who are a Discord member. Thank you for sending this. So this is CPI for UK mobile phone prices compared to every other country in Europe. Okay. And this is not the only chart that looks like this, where the prices in the UK have gone through the moon and they've been falling in the other European countries. The same charts are available for internet provision and telecoms, etc. Now, what's going on? Either UK consumers are being ripped off, and we're all, accepting these inflation um, linked contracts, and so our prices are going steadily up, whereas every other countries are going down, or the ONS is not properly accounting for customer switching. So, frustratingly, the article did not provide a solution. But what's certainly true is headline mobile phone prices. This is services, mobile phone services in the UK have gone up when in every other country they've gone down, and the differences are not small.
Huge, isn't it?
Yeah,
So the moral of the story actually is buy your phone and have a and just have a SIM that you pay for whatever.
yeah,
Don't take out a contract, which is what I do.
right. No, well, I used to be on Vodafone, and they kept, during COVID, they wanted, big inflation increase. And it was like getting to, this is a few years ago now, £24 a month. And so I switched to Smarty and got a more data for £8 a month. You know, so that's the question. Is the ONS correctly,
Mm.
accounting for switching?
Yeah. This is
Oh,
this is dreadful, Keith. This graph. I mean, talk about freedom of speech.
oh, that's not important anymore, Richard.
Most of this happened under a Conservative government.
I
I mean,
know, it's absolutely shocking.
just what they, the other thing I've got to say, I have to say this, right? If you look at the debt, UK government debt chart,
Yeah,
who was Chancellor when the debt absolutely completely screwed this country? It's Rishi Sunak.
I know. Yeah, I know. Yeah, but
And he writes for the Sunday Telegraph or something, doesn't he? And I refuse to read his article.
yeah. Well,
So did read one the other day where he although he was prime minister, he couldn't do anything about whatever it was. I was like
yeah,
pathetic.
yeah.
Sorry.
Anyway, so I'm a member of the Free Speech Union, and we actively fight against this woke nonsense. But here we go. We're good at something. Woke censorship. You know.
I don't think
Quote.
you can say that, Keith. That's quite offensive.
Oh right, yeah, you're right. And I thought this is so true. Andy Burnham. The problem is neoliberalism, as look at everything down below. That with successive governments have been constraining free markets in every way possible. You know, and I love the socialist elite. This is Nicola Sturgeon. Whose husband had been embezzling money from the Scottish National Party to buy her loads of shoes and stuff. And it always amazes me. When you see like Nicolas Maduro, etc., they've all got fancy cars and Rolex watches. While the masses suffer. No, surely she should be buying. Making a point of buying her shoes from the local Freeman Hardy and Willis. That dates me.
Doesn't it just?
Yeah, it does. That's the
It
first
went
shoe
bust
shop that
it
came
went
into my.
bust years ago, didn't
Yeah,
it?
it did. Anyway, so the bottom line is, the numbers not great. Service PMI slowing, retail sales slowing, not much data, but is the UK economy, which has been growing faster than expectations, finally running out of luck? Question mark. And onto the EU. So not much data. Manufacturing PMIs, weak, down a bit, weak. Services PMIs, bad. Composite, bad. Construction output, negative, better than expectations, but still down on year on year. Consumer confidence, up a bit, but still bad. This is good news. Inflation expectations appear to have peaked. Services sentiment, positive but weak. Industrial sentiment, negative. German job postings, going nowhere. Wage growth at least is compatible with the 2% target. French job postings, weak. French wage growth, 1.2%, very good, compatible with 2% target. So EU summary, well, not doing great, really. EU economy is actually showing signs of slowing, stagflation. And onto the US, Richard.
Thank you, Keith. So US GDP, 1.6% in the quarter. Pretty good. Corporate profits down 0.4% in the quarter.
Yeah, I found this odd.
Because consensus expectations are an increase of 5.7%, which is huge.
Yeah, but also, when you look at S&P 500 forecast earnings growth is off chart.
Yeah.
And you've had one quarter in which the national accounts is saying that corporate profits actually fell.
Yeah.
So either two things are going on. Either the big tech monopolies are making huge amounts of money and the rest of the economy is not.
Yeah.
Or it's that corporate profits being reported by big companies are, being made up of non-national accounts numbers, like, their holdings in other companies revaluing.
Yeah.
But this is not good.
No. Yeah, inflation month on month, 0.4%, and year on year, 3.8% and rising. Core PCE month on month, 0.2%, and year on year, 3.3%, rising.
So will the Fed be looking through this quotation marks transient inflation? We have been here before. I bet they will. Markets expecting them to raise rates.
Yeah. What's Trump expecting, though?
Yeah. Well, Trump will be down the phone to Kevin
Far more
Walsh
important
saying,
than markets.
Yeah. Well, he'll be saying, I've pointed you. Now you've got to do what I said.
And the 2% target is a distant memory, and getting more distant by the month. Personal consumption, expenditure, price index. There's a strong upward impulse in inflation there. And Goldman Sachs is estimating that tariffs have added around 0.7% to US core PCE inflation.
Which is big, actually. Trump has got really lucky with the AI boom.
Yeah. Durable goods orders up 8% in April, which is obviously very good. I don't know what that relates to. Maybe it's smart bombs.
Probably. Not sure they can make them fast enough to increase orders by 8%.
The US personal income month on month unchanged.
Yeah, now that's interesting actually, because massively missed expectations. But and when you look into it, it was mainly due to subsidies, drop in farmer subsidies, so nothing to worry about.
Yeah. US the personal spending month on month 0.5%. I mean, that's perfectly fine, isn't it? It's just bouncing around within that sort of range.
Yeah.
Manufacturing PMI is 55.3, so pretty much online and quite looking chart.
That's a good number.
So is his PMI basically unchanged on last month?
Yeah, and that is not a good number.
Composite PMI unchanged on last month. Chicago National Activity Index, well, up a little bit, but I don't know, it's hard to see what's going on.
Well, it's saying that there's nothing to worry about, that in April, the US economy was operating just slightly above average.
Yeah.
So, don't worry about it.
Yeah. The Conference Board Leading Index is looking...
Well, it's been totally unreliable.
It sort of oscillates around the constant economic index, doesn't it?
Well, the thing is, previously when it's turned down, you get a recession. This time, it's collapsed. No recession.
Yeah. Consumer confidence index is trending downwards.
Yeah, it is.
Building permits, actually, it's slowly trending downwards, but over multiple years.
That I agree. I think that's right.
Housing starts looks actually the same chart, which isn't surprising. Housing starts 1.47 million. Not much difference to the previous month. So Case-Shiller month on month, and year one, basically Case-Shiller is 1% in March, and year on year is 0.8%.
Yeah. So, negative real house price inflation in the US, which is what you'd expect given, higher interest rates.
Yeah. Initial jobless claims looking fine. Continuing jobless claims looking fine. Indeed, jobs postings index looking fine. Wage growth actually looking okay, 2.4%.
Yeah.
Link up postings falling, but we haven't really seen any link up between link up and actual jobs.
Yeah, that's true.
Dallas weekly GDP estimate 2.6. Atlanta Fed 3.8. New York Fed 2.5. And St. Louis Fed an outlier at 1.
Yeah. But generally all look okay. Now, actually, Richie, so last week you were skeptical about the Lantern Daily Index.
Right.
Okay, so thank you once again to Mr. C. Peckham who put us onto this. Now, let me explain what the Lantern Daily Index is, because it does not use daily data. Okay, that's what you need to know. Essentially, it is similar to the Chicago Fed National Activity Index, but whereas the Chicago Fed National Activity Index is calculated monthly, what the Lantern Daily Index does is it calculated on a daily basis whenever the data is published. Okay, so it updates the moment you have data, so that it is more. Is the idea is like the Chicago National Activity Index, but more timely. So you get a kind of more real-time indicator of when the data comes out, and it aims to look at US nominal GDP growth, and it tracks 45 widely followed indicators across 8 categories: labor, business, consumer spending, inflation, housing, income, GDP, and consumer confidence. Okay, and the latest data still pretty good.
Okay, so I'm sorry I disparaged it. Clearly, it's more sophisticated than I am.
That's right.
And yeah,
looks all right.
Mm-hmm. Yeah, so the true inflation 2.2%.
Yeah, well below the official numbers.
Mm-hmm.
So,
but climbing.
Yeah, but climbing.
The mortgage rates are increasing.
Yeah, which is absolutely what you'd expect given the rise in the 30-year rate.
Yeah.
And, given that house price in the US shot up during COVID, then you expect the housing market to be struggling, which, to be fair, it is.
Auto loan more than 60-day delinquencies are at the highest level since this chart begins in 1995.
Yeah. Yeah, that is clear sign of financial stress for US consumers. And these are not small numbers, actually. 7% of subprime borrowers.
Mm. And US savings are falling at a rate of around about 3% actually per annum at the moment.
Unsustainable. So, this all adds up to clear signs of stress.
Yeah.
But as we've talked about before, income equality in the US is so extreme that, the bottom 50% are only about 20% of overall spending. So, they're not actually that relevant to the economy.
Labour productivity is increasing very sharply for the last couple of years.
You see, so labour productivity is increasing, but I was skeptical because I was wondering how much this is a function of the capex boom. So you're getting this big surge in GDP, or
without a big increase in employment.
Yeah,
it might be, mightn't it? I agree. It'll be interesting to see what it does over the next couple of years. Tariff refunds are being processed quickly and
Yeah.
boost to US companies and the US economy. Obviously, it's a temporary boost.
Yeah, absolutely. But previously when we were talking about tariffs, increasing tax revenues and reducing the US deficit, well, that didn't work, did it?
Gone the other way now. And US tax refunds hit a new high in 2026.
Yeah, but they're mainly being processed, so that boost to US consumers will now start to fade. And as we've shown you in the previous charts, they're at the bottom end, they're already in financial stress.
Yeah. And deficit forecast of about 5.9% of GDP this year.
Yeah, totally unsustainable.
Yeah. So there's the summary, and bottom line is US economy continues to enjoy good economic growth.
Yeah. Okay, thank you, Richard. On to one chart. Now, this shows the decline in entry-level jobs. So when we were talking about NEETs earlier, young people are finding it increasingly difficult to find a job. And a lot of people have been putting that down to the rise of AI. And certainly, the number of entry-level jobs has dropped substantially since the advent of AI. But actually, the decline started much earlier, and it started during the pandemic and the rise of remote working. And there are good reasons to think that actually the decline in entry-level jobs is primarily a function of the rise of remote working, because remote working makes it more difficult for new employees to learn the job. Generally, you learn the job by chatting to your senior, more experienced colleagues around the water cooler, and those little everyday interactions where you're just sitting next to them and chatting and asking about how you do this, that, and the other. Once you're working remotely on your own in your bedroom, it is more difficult to learn the job, and that raises the cost of training for employers relative to experienced workers. So you'd expect demand for new employees to fall compared to experienced workers, and that it seems to be what is happening.
I just think I sort of wonder whether this person has wrapped a narrative around the data that is wrong. so
Well,
so clearly, there's a rapid decline that begins towards the end of the pandemic. Absolutely,
yeah,
but is the explanation the training costs, or is the explanation something different? Because fundamentally, companies hire the staff that they need, but B, they can get.
yeah.
And is it actually not that they don't want to hire junior people because they cost more to train? I have a little bit of difficulty in sort of rationalizing that argument, to be honest.
Mm-hmm.
Or is it because they can get experienced people, and therefore it makes sense to hire experienced people?
But surely there's a demand for both.
Well,
And
maybe there is, but I don't buy that it costs more to train someone remotely than it costs. I just don't buy that.
okay,
So therefore, since I don't buy that, what might be the reason? And the reason might simply be that companies are actually able to find experienced people.
but we haven't seen an increase in unemployment, Richard.
No, we haven't.
So, which would be,
But
increasing availability of experienced workers. And this is from an academic paper.
yeah,
And
but I still don't. Sorry, Keith. I don't buy the fact that it costs more to train someone remotely than it does if they're in the office. I just think they've created some explanation for it.
well, I think, trying to train new workers when they're working remotely, I think that is more difficult.
I just don't buy it as an explanation.
Okay. Well,
we'll never know the truth.
Well, there you go. Well, you can all make up your own minds, but basically this chart shows.
Or you can make up your own explanation and let us know.
Yeah, I think you'd have to write a scientific paper. But so if you
Sorry, Keith, we have to be careful. An economics paper is not a scientific paper.
Right. Okay, you're right. Very good point, Richard. Well, you can get ChatGPT to write it for you.
An economics paper is a paper in, I don't know.
Yeah. Oh, right. Okay. Yeah. Um, so anyway, pause, have a read. But basically, they're saying that AI is not responsible. Remote work is responsible, and with the correct adjustments, then it's clearly remote work, not AI. And when you ask young people are increasingly young people want to go into the office because they realize this, and they'd rather not be stuck in their bedrooms. They'd actually want to
I mean,
spend time with their co-workers.
this was just, I used to look at when I was working during the pandemic and people were working from home, I'd see them, they'd be, you could see their bed in the background, and I was just
I
thinking,
know.
this is appalling.
I know.
This is absolutely dreadful, and we're inflicting this on. I mean, this is a don't get me started moment. But
Mm.
of course, Gen Z they don't want to be remote working. I mean, of course they want to be able, and they may want to do a bit of it, but they better get to meet people in the office, to socialise, to go out for a drink afterwards, don't they?
Yeah, absolutely. But frankly, the gerontocracy didn't care. You know,
No,
there was no,
neither did Boris Johnson.
yeah.
You know,
BBC Radio 4, lockdown for every year for flu. Yeah.
Yeah, and also, why haven't we locked down sooner, harder, faster, more? Not
No.
why are we locking down? Did they ever once say why are we locking down? It's why haven't we locked down? Bloody
Yeah.
Nick Robinson.
Yeah.
Maybe cut that bit.
I'm not going to. No. Now, actually, while we're on this, okay, so
Oh, has he come back?
yeah, he has come back.
Good.
Yeah, you cynical git. He's come back with riposte. So,
Okay.
from last week's episode, Richard was questioning how much use Simon's charts were, given that, ideally you want to be investing down here, not up here. And the question, could technical analysis have told you to get in back here somewhere useful before Sienna Corp, which make optical networks, went through the moon? Okay, so Simon W has gone back and he's looked at it and he says absolutely yes, because there was a golden cross here.
Ah,
You would have got in, May 2025. So here, kaboom. And there's shares up 70% or plus from there. And more than that, Richard. So anyway, if you're interested, pause, have a read of his explanation, which is in the text boxes to the top left. Note how the share price smashed through the resistance line here. That's in September and just went through the roof. So, smashing through these upper resistance lines is a big bullish sign. And when you look, the other thing is Simon's done this before. So Sienna, it turns out, is a .com stock, and he made loads of money on it back in the .com era, and then he's aiming to do the same again here.
okay. I completely. I think that the analysis of that little point of it in sort of early 2024 to 2025 is really interesting, and that makes a great deal more sense than seeing a long-term chart with a few lines on it. I think that's it, and it's also really useful to see it going back to 2000 and see where it has been, and the very, very long period down in the wandering in the wilderness.
Yeah, well, but at the same time, this appeals to all my prejudices, Richard. I wouldn't touch it with a barge pole now. I mean, like,
Not now, I agree.
yeah, it could double, but the speed with which it declines, could you really time that to get out?
No.
Hmm.
That's the problem. I don't know how you do get out of those once you're in. I mean, it's a nice position to be in some senses, but getting out is fraught, and you will never get out at the top, or you might if you're very lucky. But
yeah, set a limit order, and then walk away when it hits it, and pat your wallet. But very well done, Simon. And now I asked him to give us a chart of a golden cross that has just been crossed. Yeah, so you can feed it in the real time. And frankly, I'm going to follow Simon in this, and I'm going to buy a little bit of Credo technology, so I have skin in the game. And this is another optical network company, and the Golden Cross has just formed. So,
Right.
if he's right, and obviously all the disclaimers we usually apply double in this, and
Yeah.
this is not advice to invest or whatever, but
And Simon's address appears at the end of this episode.
yes, with the target on his back. Anyway, thank you, Simon.
Yeah. Thank you, Simon.
So, quiz of the week. How long does family wealth, and this is an academic paper from the UK, how long does it last? Now, proverbially, it lasts 3 generations, yeah?
Clogs to clogs in 3 generations.
Yeah. So how long do you think it really lasts?
3 generations.
Um, Actually, it seems to last as long as this scientific paper, which is 5 generations. It does decline, but then it stabilizes. And this is really interesting. So they looked at 447,000 English people between 1600 and 2026. And so the reason persistence of wealth is quite surprising in that the actual wealth dissipates quite quickly within 3 generations, as per the proverb. But the wealth is used to invest in education and social links. And so wealth persists within the family because subsequent generations can look after themselves and create their own wealth. And the other thing I found interesting about this study, thank you to Stuart Owen for this, is that when you look at like upper middle class families over the period, their wealth is very stable. So they are educating their children, marrying them into similar families, and they're all becoming doctors, lawyers, generation after generation, and they remain stably upper middle class for generations. So what's really interesting is that if somebody wins the lottery and they invest in educating their children, they can preserve that wealth. If they just hand over the money, then the wealth will dissipate. So you heard it here first. If you win the lottery, send your kids to university, but not the University of, Southeast Anglia.
I think, yeah. Education.
Right. And right, well, so again, we're always overrunning. So we'll do this one quickly because I thought this was quite interesting. Because right, fusion power, as you all know, I've got a big position in oil, etc. And if fusion power comes to reality, and it's always been 30 years away, then suddenly the price of electricity and energy goes to zero, and that would be very bad for me, very good for the economy. And Helion Energy has signed a deal with Microsoft to provide fusion power to its data centers starting in 2 years' time. Okay. And they've started the power plant here. So they appear to be very confident that they can start producing new fusion power within a couple of years. Actually, to start providing fusion power in 2028. Okay. Now, the big problem with fusion power is the fast neutron problem. They therefore must be very confident that they've found a solution to the fast neutron problem. So, which is in a fusion reaction, you get a lot of energy released, plus you get these neutrons flying out at high velocity. And these high velocity neutrons contain 80% of the energy of the fusion reaction. But obviously, neutrons are difficult to control because they can't be controlled by magnetic fields. And the trouble is, high energy neutrons will then collide with the nuclei of whatever is in the wall of your fusion reactor. knocking out, alpha particles and bits from the nucleus, causing them to become radioactive, uncontrolled nuclear, reactions in the walls of the containment vessel, all really bad. And in particular, what you're doing is you're knocking generally helium atoms out of the nuclei and they form helium gas. And so we talked previously about hydrogen embrittlement. Well, helium embrittlement is a similar problem. So helium molecules will migrate to the fractures in the walls of the steel containment vessels and will create fractures and make them brittle. And it will also convert iron into chromium, all of which just degrades the strength of the containers. So the basically the whole container becomes weak nuclear radioactive waste over time. So how do you fix that? Well, you can either use advanced materials or helium absorbing materials within the steel, or you can use a different reaction whereby you put lithium within the walls and that absorbs the fast neutrons, breeding tritium. Now, Helion are the company which claims to be able to produce fusion power within 2 years. And what they're doing is they're using a different reaction. It's the deuterium tritium reaction, which does not produce fast neutrons. Instead, it produces protons. But the reaction requires higher temperatures than the usual reaction, i.e. around 200 million degrees C. And the advantage of the deuterium helium-3 reaction, which they're using, is that because it uses charged protons, these can be captured within the magnetic field. So what they're doing is a pulsed fusion reaction within a very strong magnetic field. But that means that essentially you need to have a stable plasma at 200 million degrees C, and none of this is proven. So you can pause, read all this, but essentially, this all sounds like you can write this down on paper, but there've been no practical demonstrations of this. They have not produced any scientific papers. They've not proved any proof that they can actually do it. In order to produce fusion power by 2028, everything would need to go right. Yet you can build a plant, but there's no proof that they've actually overcome any of the fundamental engineering hurdles to produce electricity from this reaction. And, this just seems like a bubble stock to me. Yes, it's committed to provide energy to Microsoft, but the fundamental problem is that you need to produce these pulsed donut-shaped plasma at 200 degrees C, an extraordinarily strong magnetic field. And historically, they've always proved to be unstable. Controlling them, 200 million degrees C, huge amounts of energy, very difficult. So 30 years away, and frankly, I think it's still 30 years away. Richard, any thoughts?
Yeah, I tend to agree with you, Keith. I might be 25 years away, might be 20 years away, but certainly I would be absolutely astonished if they achieve this by 2028.
So once again, we've overrun, and I'm not going to get through any of the other special sections I want to get through, which are on Japanese debt crisis and the Utica shale, etc. We'll do those at some stage, but we need things to calm down so we can just chat. So previously, we've been very skeptical about EV trucks after the Nikola debacle, where they basically were just rolling it downhill. But it turns out, quietly in the background, they have been developing them. So this is the Windrose semi-trailer, whatever that means, EV truck, which has a range of 416 miles at 49 tons and boasts 1,400 horsepower. It just completed a 186-mile trip from Canberra to Sydney in Australia and claims to have reduced fuel costs for the journey by 84%. Though I notice it was carrying toilet paper, which is not very, you can fill it up.
Not very heavy.
You're not very heavy. If
It's
you were to fill it up with,
30 tons of toilet paper weighs the same as 30 tons of cast iron.
no, that is true. But, 30 tons of cast iron
Yeah, exactly.
would take up this tiny fraction of the thing, So, yeah, as long as you don't carry too much. And concluding comments, well, they're the same as the last month, basically. Every time, as I said last time, Iran's best strategy is to try and wait until the oil price goes to the moon. At that point, Trump comes under irresistible pressure to just capitulate and let the straits open. At which point, Iran is left in control and it's seen as both the military and political winner. So Iran is going to just keep on keeping the straits closed until the oil price goes to the moon, as far as I'm concerned. So, yeah, I'm staying long oil. Richard, any thoughts?
No, I think I agree with you, Keith. I think we've covered it all in quite a lot of detail, and we're in a very uncertain period, aren't we? But I don't think you can go far wrong if you've got oil stocks.
Yeah. So, thank you all for watching. Please press like and subscribe to the channel. And the next one will be not this Friday, but next Friday. And I hope to talk about some of the special sections I've produced. Okay. Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.